Picture an account, an illustration, holding $500,000. It never grows, never shrinks. At 71, the rules force out about $26,400. At 90, about $59,600. Nothing changed but your age. An RRSP defers tax. It does not erase it. Today, we walk the whole life of that account. The deduction going in, the tax coming out, the withholding that is not your real bill, the clock at 71, the old age security line, and the bill at death. And then the one comparison that decides whether the deferral worked in your favor. No pitch, just the math. Start with the half everybody has heard. You put money into an RRSP and you deduct that contribution from your income at your marginal rate, the rate on your top dollar of income. Inside the account, the money generally compounds with no tax charged along the way. Each year you add new room, 18% of your previous year's earned income, up to an annual dollar cap. For the 2026 tax year, that cap is $33,810. For 2025, it was $32,490. And room you never used carries forward, so your actual limit is usually larger than a single year's worth. That is the deal as it is usually sold, and every word of it is true. It is also only the first half of the sentence. Here is the second half. Money you take out of an RRSP in retirement or out of the RRIF it eventually becomes, is added to your income in the year you take it and taxed as ordinary income at your marginal rate. That phrase is carrying weight, so let us be exact. There is no capital gains treatment on the way out, none of that only part of the gain is taxable arithmetic, no dividend tax credit, and no preferential rate. It makes no difference whether the money inside grew from interest, from dividends, or from a stock that tripled. Coming out, it is all one kind of income, the same kind as a paycheck. So the account did not remove the tax, it moved it. Think of a silent partner in that account since the day you opened it, and the withdrawal is when the partner gets paid. If this is the kind of explanation you have been looking for, the arithmetic, the source on screen, nobody selling you anything, subscribing tells me to keep making it. That is the whole ask. Now, the part that catches people at filing time. When you take money out of an RRSP, the institution holding it withholds the tax. Outside Quebec, the rates are tiered. 10% on amounts up to $5,000, 20% on amounts over $5,000 and up to $15,000, and 30% on amounts over $15,000. Quebec is different. The federal portion is lower at 5%, 10%, and 15%, and a separate provincial withholding applies on top of it. For that provincial rate, the CRA sends you to Revenue Quebec, so I will not put a number on it. Here, I want to stay close to the CRA's own words. The tax that was withheld, they say, may not always be enough to account for the tax you owe at your tax bracket, and you may have to pay more tax on the withdrawal when you include it on your income tax and benefit return for that year. So the withholding is not the bill, it is a down payment on it. The withdrawal gets added to everything else you earned that year. Pension income, CPP, interest, all of it. Your real tax is calculated on that total, at your marginal rate. The withheld amount is subtracted from what you owe, and if it did not cover the tax, you pay the difference when you file. And for many people, that difference is the surprise. They watched tax come off at the withdrawal and reasonably assumed the tax was handled. That is a pattern, not a statistic. I am showing you how the withholding settles up so that none of it is a shock in the spring. An RRSP is not allowed to stay an RRSP forever. By the end of the calendar year in which you turn 71, the account has to become one of three things: an RRIF, a registered retirement income fund, an annuity, or a lump sum withdrawal, which is taxed in full that year. There is no extension. I want to be careful with the tone here. There is nothing to rush toward. It is a documented rule with a date attached. Converting to a RRIF is one of the three ways to meet it, and it is where the next piece of arithmetic lives. An RRIF has a floor under it. Every year, you must withdraw at least a set percentage of what the account was worth on the 1st of January. That percentage is prescribed by the government, and it climbs with your age. Here is the schedule. The government's table has more than one column, and these are the factors from the column it calls All Other RRIFs. At 71, the factor is 5.28%. At 75, 5.82. At 80, 6.82. At 85, 8.51. At 90, 11.92. And at 95 or older, 20%. Now hold the balance still so you can see what that schedule is doing. Take a RRIF with $500,000 in it, and imagine, this is only an illustration, that it neither grows nor falls. At 71, the minimum you must withdraw is about $26,400. At 90, on the very same balance, the minimum is about $59,600. More than double the forced payout, from an account that did nothing at all. Not what you need that year, not how the investments performed. Just the number of birthdays you have had. Real balances move up and down, which is exactly why that $500,000 is an illustration and not a forecast. But the percentage only travels in one direction. Drop a comment and tell me which province you are watching from. The federal rules here are the same everywhere, but the tax rate sitting on top of them is not, and I would like to know who I am talking to. Now set two schedules side by side because nobody wrote them to fit together. That forced RRIF withdrawal is fully taxable ordinary income. It lands on top of your CPP, your old age security, your workplace pension, everything else. And old age security has a line drawn through it. Once your net income for the year rises above a threshold, you repay 15% of every dollar above that line. That is the OAS recovery tax. Most people call it the clawback. For the recovery tax period running from July 2026 to June 2027, the one governing right now, the threshold is measured against your 2025 net income, and it sits at $93,454. And it does not stop at 15 cents. For that same income year, old age security is reduced all the way to zero at $152,062 for ages 65 to 74 and at $157,923 for ages 75 and up. So the RRIF minimum climbs every year by rule, regardless of what you need. The recovery tax is a line drawn in your income. The two schedules were written independently of each other, and the place they meet is your tax return. That is not a prediction about you. It only bites if your income reaches that line. It is simply what the two schedules do when they are left alone. One more place the silent partner collects, and it is the last one. When the annuitant dies, the law treats them as having received immediately before death the fair market value of whatever was left in the plan, and that lands as income on the final return for the year of death. The whole remaining balance, in a single year, taxed at whatever marginal rate a year of that size produces. Whether that is the largest tax event the account ever sees depends entirely on the estate, and I am not going to put a number on it. There is a major exception, where the money goes to a surviving spouse or common law partner, or to a child or grandchild who was financially dependent on you. It can be deducted from that deemed amount, so where that rollover applies, the tax is not triggered at that moment. The bill is not paid at the first death. The balance carries on, and it carries its tax with it. Now, the counterweight, because everything so far could leave a false impression. The RRSP is not a trap. Every mechanism in this video is the machinery working exactly as designed. The deduction was real. The tax at the other end was always part of the deal. Here is the comparison, and it is the whole story. If your marginal rate back when you contributed was higher than your marginal rate when the money comes out, the deferral nets ahead. If your rate at withdrawal is higher than it was at contribution, the deferral nets behind. Favorable, neutral, or unfavorable, that one comparison decides it. And as a general pattern, not a promise and not true of everyone, many people do sit at a lower marginal rate in retirement than in their peak earning years, and that is exactly the case where deferral pays off. Someone arriving at 71 with a large workplace pension, a large RRIF, and CPP and OAS on top can land at a rate as high as the one they deducted at. So the RRSP is not the problem. What surprises people, as a pattern, is that only half the sentence gets planned. The other half is the rate you pay when the money comes out, the year the RRIF schedule starts choosing the amount for you, and whatever is left in the account at the end. You now know every point where the partner collects: at withdrawal as fully taxable ordinary income, at the withholding desk, which is only a down payment, at 71 when the account must convert, every year after that at a percentage that climbs with your age, at the old age security line at 15 cents on every dollar above it, and at the end on the final return. None of that is a verdict on the RRSP. It comes down to one comparison: your rate going in against your rate coming out, and only your own numbers can settle that one. So tell me what to run the numbers on next. How the TFSA fits around all of this, what pension income splitting actually does, leave it in the comments. Like the video if it earned it, subscribe if you want the next one, and thanks for watching. This video is education, not financial, tax, or legal advice. Everyone's situation is different, so talk to a licensed professional before making decisions.